In this video, we'll share 3 effective ways to use the moving average indicator to generate precise trade signals. If you're serious about trading, if you want to learn more strategies like this, like video and subscribe channel. Now, let's dive right in. What is a moving average? A moving average, MA, is a technical indicator that calculates the average closing price of an asset over a specific period. For example, a 10-period moving average calculates the average closing price of the last 10 candles. The primary purpose of a moving average is to smooth out market noise and provide a clearer view of the overall trend. Different moving averages serve different purposes. A 200-period moving average helps identify long-term trends. A 20-period moving average is commonly used for short-term trend analysis. The 20, 50, 100, and 200 moving averages are among the most popular in trading. In general, traders use moving averages to understand market trends and simplify price action. Now, let's explore 3 key ways to use moving averages for better trading decisions. 3 key uses of the moving average. Number 1. Identifying market trends. Number 2. Identifying trend reversals. Number 3. Identifying dynamic support and resistance. Identifying market trends. Since the moving average is a trend-following indicator, its primary role is to help traders determine the market trend. There are 3 main techniques to achieve this: price versus moving average. The relationship between price and the moving average can indicate the trend direction. If the price is above the moving average and remains there consistently, the market is in an uptrend, signaling potential buying opportunities. If the price is below the moving average and stays there, the market is in a downtrend, signaling potential selling opportunities. If the price frequently crosses above and below the moving average, the market is likely range-bound, meaning it's best to wait for a clear trend. A great way to improve accuracy is by using 2 moving averages with different periods, one for short-term analysis and another for long-term trends. For example, let's analyze a chart with a 20-period moving average, yellow line, for short-term trends, a 200-period MA, blue line, for long-term trends. By focusing only on the 20 MA, we can identify an uptrend when the price is consistently above the 20 MA, a downtrend when the price stays below the 20 MA. However, if we add back the 200 MA, we can see the long-term trend, which helps us filter out risky trades. For example, if the price is above the 200 MA, we should prioritize buy trades even if short-term moves suggest otherwise. If the price is below the 200 moving average, we should look for selling opportunities. Moving average slope. The slope of the moving average also provides insight into trend strength. A steep upward slope, approximately 45-degree angle, signals a strong uptrend. A gentle upward slope suggests a weak uptrend. A steep downward slope, approximately 45-degree angle, indicates a strong downtrend. A gentle downward slope suggests a weak downtrend. Understanding slope strength helps traders decide whether to enter trades aggressively or cautiously. Small versus large moving average. Using 2 different moving averages, such as the 50 MA and 200 MA, also helps confirm trends. When the 50 MA, smaller, is above the 200 MA, larger, the market is in an uptrend. Look for buying opportunities. When the 50 MA is below the 200 MA, the market is in a downtrend. Look for selling opportunities. Identifying trend reversals. Traders can use moving averages to detect potential trend reversals using 2 key methods: price crossover. When the price crosses below the moving average, it signals the end of an uptrend and the start of a downtrend, bearish reversal. When the price crosses above the moving average, it signals the end of a downtrend and the start of an uptrend, bullish reversal. However, not all crossovers indicate real trend changes. Many are false signals. Moving average crossover. To avoid false signals, traders often use a moving average crossover strategy. If a smaller MA, e.g. 50 MA, crosses below a larger MA, e.g. 200 MA, it signals a bearish reversal, downtrend beginning. If a smaller MA crosses above a larger MA, it signals a bullish reversal, uptrend beginning. While moving average crossovers can indicate potential reversals, they should be used in combination with other factors for stronger trade signals. Identifying dynamic support and resistance. Unlike traditional support and resistance levels, which are fixed price zones, moving averages provide dynamic support and resistance. In an uptrend, the moving average acts as a support level, meaning traders can look for buy opportunities when the price retraces to it. In a downtrend, the moving average acts as a resistance level, meaning traders can look for sell opportunities when the price retraces to it. For example, if a stock is in an uptrend and bounces off the 50 MA multiple times, this confirms the 50 MA as a strong support level. Similarly, if a stock is in a downtrend and repeatedly gets rejected by the 50 MA, it acts as strong resistance. By using moving averages this way, traders can make better trade decisions with improved risk management. Final thoughts. The moving average is a powerful tool that can 1. Identify market trends, price versus MA, slope analysis, and dual MA strategy. 2. Spot trend reversals, price crossovers and moving average crossovers. 3. Act as dynamic support and resistance, helping traders find high probability trade setups. When combined with other technical analysis tools, moving averages can significantly improve your trading strategy. If you want to learn more strategies like this, PLs, like video and subscribe channel. That's it for this video. Happy trading!